Just looking over my comment section when I make supermicro computer stock videos, I can see that there are a lot of investors that are upset they missed out on supermicro computer stock. The rapid rise in the stock price left many investors behind. So if you're looking for an AI stock to invest in, but are a little bit hesitant to jump into super micro computer stock at these higher levels, I've got one AI stock you can buy instead. So let's jump in. Let's take a look at what this stock is and why I think it makes an excellent investment for AI stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock I'm recommending here in this video is Intel. Intel is an excellent stock that's positioned to capitalize on the rising effectiveness of AI, and it's not expensive at all. I mean, especially when you compare it to Supermicro Computer. If you look back the last 3 years, Intel stock price is actually down from the highs of over $60 per share, even though it's jumped up in 2023. Since 2023, it's up to $43 per share. It's still not back to where it was at its heights. And I'm going to show you in this video several of its characteristics that make it an attractive AI investment. If you compare it, I mean, look at Supermicrocomputer's chart for the last 3 years. Look at this explosion in stock price. I mean, it's been just phenomenal. It's been rapid. It's been violent. The increase has been absolutely violent. And that's left many investors behind because you were just caught off guard by this rapid increase. And, I made a video, I want to say like mid-January, where Supermicro Computer at that point was already up 80% to start the year. And I told investors that the stock was still a great value even after it was up 80%. So I recommended Supermicro Computer stock as a buy. I still have it rated as a buy, although I'm not as strongly recommending Supermicro Computer stock now after this violent price increase, even after that 18% dip that the company experienced on that end of week on a Friday. I still wasn't feeling like the stock is extremely undervalued or it's in an excellent position at this point after the rapid price increase. If you look at its valuation on a price to earnings basis, it's trading at a 62.69 PE ratio, which is expensive. But if we incorporate its absolutely excellent growth prospects, if we incorporate that into the valuation, which means we're looking at the forward 1-year price to earnings ratio, it doesn't look that expensive. It's trading at a forward PE of 27.48, which is not incredibly expensive. It's right about a fair valuation, in my opinion, at this price. But you could see over its history, over the last 3 years, I shouldn't say history, 3 years is not long enough to compose of a history, but in this time frame, the stock price was trading at a forward PE of around 10 or below. And so it's increased by nearly 3x in terms of valuation. So yes, the company has excellent prospects, but very much of those excellent prospects are now incorporated into the valuation. And so that's why if you missed out on Supermicro Computer stock, I think Intel makes a good investment. Intel is trading at a forward price to earnings of 18.64, which is the opposite of what's going on with Supermicro Computer. Intel is trading at the cheapest it's traded for in the last 3 years, whereas Supermicro Computer is trading near the most expensive it's been in the last 3 years. Now, that is justified. Supermicro Computer's prospects are excellent for the rest of this year and next year, but those prospects are expected to slow down in 2026 and beyond. The difference here is Intel may not have as phenomenal prospects as Supermicro Computer does over the next 2 to 3 years, but its prospects are pretty strong as well. Let me show you precisely what they are according to Wall Street. So according to Wall Street, they expect Intel's revenue growth to increase by 5.7% in fiscal year 2024 and earnings per share to rise by 28.7%. For 2025, Wall Street expects Intel to increase revenue by 11.6% and earnings per share by 65.8%. And then again in 2026, a solid 9.4% revenue growth compared to a 31.4% increase in earnings per share. So excellent earnings per share growth expected for Intel, with solid revenue growth expected. The company just told investors that they completed their cost-cutting plan, more than $3 billion in savings they achieved in 2023, and they expect more to come in 2024. In fact, Intel's CEO in their latest quarter said, "We expect to unlock further cost savings and efficiencies in 2024 and beyond, and we're aiming to drive our long-term model of 60% gross profit margin and 40% operating profit margin." 40% operating profit margin would be incredible and would be higher than what the company has achieved in its past. I can show you its longer term operating profit margin going back a decade. Here's its operating profit margin in a trailing 12-month period for the last decade. The highest it achieved was 33.61%. So an operating profit margin of 40% would mean it eclipses its former peak in terms of operating profitability. Now, it is well on its way to do that. Those cost-cutting initiatives have been working well, and it's in an excellent position to benefit from this next personal computer replacement cycle with the AI enhancements that are going into personal computers that are making them more attractive for customers to upgrade their older models and to pay more for the more feature-laden models coming with AI enhancements. So these are excellent factors for Intel and Intel stock investors. And you could see one of the characteristics that I find very attractive in investments. Number one, the company is demonstrating second derivative growth for the next 2 years. They are increasing the rate of revenue growth from 5.7 to 11.6 and increasing the rate of earnings per share growth from 28.7 to 65.8. So that's the rate of growth increasing. Not only is the growth rate solid, but that rate of growth is increasing. So double top and bottom line second derivative growth for Intel expected over the next 2 years. Additionally, its earnings per share growth of 28.7% and 65.8% are above its PE ratio, where it's currently at 18.64. It's more than twice that level, right? So 28.7 and then 65.8. If we average that out, it's more than twice the level of its price to earnings forward ratio. So the stock is trading at a PE ratio below the earnings per share growth rate. And that's another attractive feature of an investment that I look for when I'm looking at a stock to recommend as a buy, or a stock to rank as a buy, or a stock to buy myself. So Intel demonstrating excellent characteristics, trading at a relatively cheap valuation, making it attractive for those of you that missed out on super microcomputer stock. I think Intel makes an excellent AI stock you can buy today instead of super microcomputer stock. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.